All right, good morning, everybody. Just starting a few minutes early. A little shameless plug, talking about the website. We did a lot of work on this last year, and I don't think we ever get to a point, where we say we're done with anything because there's always room to make changes or make something different. But for the most part, I mean, we're really pleased with the outcome of the changes we've made. If you've never been to our website, you ought to check it out. This is where, the bulk of our educational content resides. And we've broken it down into courses, trying to take you from the very beginning of being a new trader and kind of floundering around through all of the different paths that you could take as a trader, and helping you focus and narrow down that path and get you into a style of trading that suits your needs and suits your account. And then from that, of course, we kind of take it over into another level for you more advanced traders. The content that I developed in the next level library is really going to be a game changer if you're trading options and you're only buying calls and buying puts. If you think about it, that leaves you on just one side of the fence. You're always a buyer. You have no other choice. You have no other tactics at your disposal. And that means you're really missing out on some of the greatest things that we can do with options. Just buying and selling them like a widget. Of course, that does have its place, but it's certainly not the only thing we can do with them. So I just wanted to throw that out there real quick. We'll get started, bring in the Zoom meeting, and bring it from the Discord. All right, good morning, everybody. We have a lot on the agenda today. 8:30, 10, 10:30, 11, 11:30. I posted some pictures in the Discord. Kind of gets a little bit of background. It's like I've said before, when it comes to the economic events, don't just check one spot and think that you have everything on the list. These are expected to be impactful today. Everybody's looking for the Fed to give them some kind of signal about where their hike is going to go, how high. And their decision is going to be based a lot on the information that they get between now and March. So every single little bit of information is going to be heavily scrutinized. This is what they use to justify the decisions that they make. They can point back and say, well, we're going to do this because of this. So it's a real big deal. There wasn't much on the 5 things you need to know. Nothing really stood out there. So they're running through the different nations' decisions on cutting rates or not. Some nations aren't cutting at all, and others are not doing anything, and then some are actually already hiking. So the different nations' decisions, they kind of covered that a little bit. Still talking about the restrictions from COVID and then the mixed markets in the overnight hours. They do give a little bit of a heads up today. The jobless claims, business outlooks, home sales, and then a few names that are on the list for earnings today. But otherwise, the 5 things you need to know didn't really have much in it that stood out. So we've been using the economic calendar from FX Street because it has this little extra excerpt about the dollar. It's important to understand when you see the dollar moving that we don't always know the why behind it. We don't want to just see a move in the dollar and immediately assume that it's a good thing or a bad thing. We want to know the why behind the move in the dollar. And that little excerpt is a nice heads up on that perspective. All right, so the ES, we had 4,500 as our critical low. We got close to it, but close doesn't count. We didn't break through it. We're already moving back up again. One of the things that's worth noting is that weekly expected move. Now we close for the week inside of that expected move more than 80% of the time. So when we are outside of the box, there's a strong indication that we're going to come back inside the box. And having said that, when it does start to fail, right? Because if it closes inside the box 80% of the time, then there's 20% of the time that it doesn't. On those 20% times that it doesn't, if it happens once, it's very likely to happen twice, right? It happens sequentially. So the markets will do really good. The market makers will project that weekly expected move accurately, and they'll just be like a well honed machine. And then when things start to get sloppy and they start missing, it misses sequentially. So, and you don't have to take my word for that. The best thing about this indicator is you can just go back and look week after week on any market. Now, of course, it was meant for the SPX. We're using it on the ES. You can use it wherever you want, but the SPX is the most accurate when it comes to an expected move out of all products in the entire universe of things that we could trade. Nothing has a more exacting and a specific expected move than the SPX. So you can go back and look at week after week and notice when it closed at the end of the week outside of the box, and then how many times in a row that happened. And you can start to understand why we use this so much, even just for analysis, let alone we use it for trading as well. So we held that low. We did not breach the 4,500. We didn't even get to the 4,500. And we're starting to get a little bit of that rally again. Now, it's the same thing as before on this, just like yesterday when we were talking about the dead cat bounce. Should we buy the dip or sell the rip? Well, they sold the rip, right? Cute little turn of phrase. Yes, it's true, but that's what we had yesterday, right? They didn't buy the dip, they sold the rip. Well, we're back into the same boat again today. We've got a nice rally up off of those lows. We're up about a half of a percent. Buy the dip or sell the rip. Now, one of the things that I would recommend for you to do today while you're watching the advancing issues on the S&P and the Nasdaq is to bring up a watch list. Or just detach this one and use it. Bring up a watch list and look at the S&P 100 or the Nasdaq 100. You want to set it by market cap. Go from high to low and keep your eye on the top 10, top 15 names throughout the trading day. If this really is a rally off of these lows and not a dead cat bounce, you're going to see these mega cap names participating in the move. If you look at the market breadth from yesterday, for an example, so this is the ES. We'll just use a comparison study. You want to know what the advancing issues were in the S&P yesterday. So at one point, the S&P 500 had over 313 names advancing, and it all just rolled over and dumped. Now, how many of those one 313 names were these mega cap companies that we were just talking about. Take the same thing with the Nasdaq. The Nasdaq had 75% of the Nasdaq 100 was advancing yesterday. It seems it seems really bullish, right? That's the Nasdaq advancing issues. We got to 75 names. And you still see the outcome. So when you're looking at those market breadths and you're looking at how many names are advancing, how many names are declining, it's what names that become very important. The FANG companies, the FANG names, have enough market weight to steer this market wherever they want it to go, right? So if they're down, it won't matter if you get 85% of the S&P rallying. If you're not getting any support or assistance from those FANG names, it's not happening, right? And that's going to be the early warning indicator that you would be wanting to look at to see this thing roll over and dump. So a nice little shortcut way of being able to do things, just add market cap to your watch list, sort them by their size. You'll see the names. So for today, with the economic events on the agenda, we really just want to mark out if or situations. If the news is good and the market does like it, where we headed, we're going to break through the top of that Globex and we will begin challenging yesterday's highest point. It's likely to be a bit of a struggle to get back up there. You want to think about the trapped traders in this area because we didn't come back to it and we left it quickly. So you know that we left some behind there. It's not out of our range. We're only up 0.39. We've got an ADR of 1.3. So we have another 1% that we could move, and it wouldn't even be considered an outsized move. Well, there's our additional 1%. It puts us around the top of that peak. That'll work. So an upside move today in the ES, we're going to be targeting the 45.90 area. It shouldn't be subtle. If the news is positive, we're going to see a lot of mean reversion across the board in the S&P 100. So it shouldn't be subtle. If the market does not like the news that's coming out today and we continue this dead cat bounce and roll over, we'll re-challenge the Globex low and we will get through that 45.11 cog and then hit the 4,500. Remember that 4,500 is the critical line in the sand. Oh, I almost coughed in everybody's ears. You wouldn't have liked that. 4,500, critical line in the sand. If you're a trader carrying a lot of trades, you might want to recognize the risk that you're holding and beta weigh your portfolio. If you don't understand what beta weighing is, come over to the Bullish Bears and come in and chat with me in the Discord. We'll help get you up to speed and show you how to use a benchmark product like the QQQ or the SPY and aggregate all of the things that you are holding. Basically, turn everything into apples so that you can do an apples to apples comparison of your risk and actually be able to measure if SPY was to fall 5%, how much would your entire portfolio get whacked? So we're able to actually do that with our accounts, and it can help you get a gauge for how much actual risk you're holding in your account. For the Nasdaq, we also had that dead cat bounce yesterday, a failure to resolve the move. We're outside of the weekly expected move still. We're nowhere close to being back inside of the box. We got to that risky level yesterday, 15,000, excuse me. We got there, we just tickled it and bounced back off. Now, if you've done any of the first touch plays, You already understand that that first blush, that touch and rebound at the moment is nothing more than a pullback from liquidity. So this pullback is very, very likely a dead cat bounce, and that was nothing more than a first touch. Just like this back here was a first touch with a pullback and a rollover. It's just a bigger pattern. So first touch. For today, it is still going to be on the economic agenda, just like with the ES. This thing is not going to move by itself. It will be based on the economic news that comes out today. If the market doesn't like it, we start heading to the downside, we break that 1500, it's going to get critical. It's going to get nasty. One of the things that you're going to want to watch for is that we eliminate this bifurcated market and we start to correlate. Now, those are just really big, fancy, fat words that say look for all of these things to start moving at the same time in the same way, right? When we're divergent, the market's actually a lot safer. But when you get everything synchronized at once, showing that the algos are hitting all of the basket all at once, you really start to see things move, and it can become very extreme. Take, for an example, the moves that we've seen in the last 2 weeks. We haven't moved huge distances. If you look at the range of the expected move, we're within those boundaries for the most part. So we haven't really made overly far moves. It was the scope and pace and speed of the move that really shook people, how fast we actually moved, right? So that's what happens when we go from a bifurcated market to a correlated market. A correlated market state is a very dangerous state, positive or negative, because it can happen to the upside too. That's what you're going to be wanting to keep your eye on today. Mega cap stocks are the only thing that can give you that heads up on the market breadth. Otherwise, the market breadth is going to be pretty much worthless to you at this point. I mentioned a positive outlook on economics today, and I mentioned a negative outlook on economics today. But keep in mind, there is one more choice, right? And the third choice would be, well, we're going to get some economic data, and it's going to be a little fuzzy. They're not going to be able to make a strong response. They're going to have to call the nerds and then wait for the nerds to give them a response. What do we do, boss? Do we buy it or sell it? What are we doing? Right? They're going to be sitting on their hands waiting for the nerds to come back with some answers. So when the events come out and we don't really see a big move, don't just shrug and say, oh, well, I guess there's just not going to be a reaction today. It could be a delayed reaction today. The decisions that they're making are going to affect where they're allocating capital for the next year. So it's a really important decision to them. They're going to take their time to get the answers that they need, and they want to get it right the first time, right? They've already had to rotate a few times in the last quarter. They're not going to want to continue that rotation. And speaking of rotation, when you start to look around asking, like, where are we going? There is this discussion that they are rotating out of risky things, assets, and in the equities to get back into the bonds. Well, if you go look at the bonds right now, they're not buying into that. And if you look at the MOC, the buy side was much lower than the sell side. So yeah, they're exiting. What the hell are they getting into? According to Bloomberg, they believe that it's going to the EEM. It's going to be over in Europe because apparently when we are in um, this stage of our economic cycle, Europe does better than we do that year. So 2022 is very likely going to see us in a slowdown and Europe doing better. And we're talking about the difference of 2 or 3 percentage points. It's not for people like us, you and I retail traders, not a big deal. So it's a little misleading that we see the sell-offs and we expect that capital rotation. We're expecting to see that they leave one thing and get into another thing, and we look around and they're not getting into something else, nothing that we can see, right? So yesterday it was IGV and cloud. That was more mean reversion than anything else. We've been using IGV and cloud as two resources to monitor very large tech companies, right? You think about what is inside of this ETF, this IGV. Adobe, Inuit, Salesforce, Microsoft, Oracle, Zoom, Activision, Now. So IGV is a really good ETF to use to be able to monitor these 8 companies without looking at these 8 companies all day long. And the other one is CLOU. It's another ETF representing a little bit of a different tech side. WDay, Netflix, Plan, Dropbox, Twilio, Shop, right? So this ETF is a representation of these 8 names and more, right? On both of those. There's more names than these 8. We're just looking at the biggest market weight names in that ETF. Those 2 were doing reasonably well yesterday to a point until they weren't. Yeah. Getting back out to the higher time frame, we do have some sectors that are just ready for a move. XME right up against those highs. XOP also up against those highs. Now, there's a lot of talk about the dollar rallying back up in the last few days. And yeah, to a point, but it's still a part of that dead cat bounce, right? It's the same discussion that we had the other day. We broke a critical level, broke out of that level, came back up and tagged the bottom of it like a Busby. Getting that rollover now. You want to keep your eye on the dollar. It's not just is the dollar moving, it's is it making big moves? Are they significant swings, or is it just grinding along, staying inside day? We had this really big day on the 18th on Friday, and now we're getting multiple days in a row where we're inside of that, right? So all of these are inside day. Be looking for that to change. So it's energy and metals. And speaking of metals, if you're looking to do research on intraday trading and trend, take a look at gold. This is a chart that should go on the wall for study. It doesn't get any better than that. There is nothing that you could study in a trend scenario to help you become a better trader, to recognize trend, to identify the different ways that you want to participate in a trending market. This is the perfect example. Take the time to take a look at it. You have 5 days to look at it in tick before you can't see it in tick on Thinkorswim anymore. Go in and really do a deep dive. If you're an intraday trader and you're trying to trade trend, there is a perfect example of it. So this morning, it's emerging markets that are leading the way. Cloud is right behind it. Got a little bit of a move in Bitcoin, not too much. The Qs and the pot stocks. Nothing else is up more than that 0.5% benchmark that we use. So those sectors are in play. On the days where we look at the sectors and we really don't see the opportunities, it's where I say we have to be stock pickers and actually go in and hunt down our opportunities using our scanners rather than leaning on the sectors. So far this morning, the sectors are offering us a lot of opportunities to go down in that direction. So you can see the pot stocks names here looking really good. Kind of back up and hit a couple of different sectors that aren't in the old school S&P 11. Crypto names. Definitely want to keep hitting back on energy just to see if we're going to get any kind of mean reversion. And the EV market, the electric vehicle market, it's also looking really good this morning. Just really be cautious. For an example, Ford is down this morning. They got a downgrade in Ford. Jeffries downgraded Ford to hold from buy. Still, Ford is on the list of strong trending names. Ford, Lowe's, Qualcomm, AVGO, couple of sideways names or low ADX names highlighted there. You could just hit this, print screen or take a screenshot. Base breakouts, Crown Holdings, which is CCK, and Global Ship Lease, which is GSL. Both of those names came from IBD's email on breakouts and breakdowns. They just send you an email every morning about names that are primed or are breaking out of a major level. Now, if you're not an IBD user, if you go over to something like CCK and you're looking at the chart, they're calling it a buy zone at the top of a range. Okay, it's literally breaking out into all-time highs. Now, when I first seen them promoting trades like this or calling out names like this, I found it really uncomfortable. Like I'm not the kind of person that wants to buy at the highs. But they don't just go through some random checklist and find markets breaking out to highs. To even be on the list that they look at, every name has to have very, very strong fundamentals first. Then it gets put on the list. Then they look for breakout opportunities. And there is the old adage of what is strong continues to be strong until it isn't. Right. So when it's demonstrating strength and it meets all of their fundamental criteria and it breaks out to all-time highs, to them that's a buy. Now, Investors Business Daily has been around for a long, long time. If this model didn't work, if they weren't able to make money doing it, they would have done something else by now. Right. So as much as it doesn't feel good or it just doesn't seem right to be buying at the highs, be open-minded about what it is that they do and what trade alert they're putting out there. They had a buy point at 113.85 and it has a buy zone between 113.85 and 119.54. Now think about the size of that buy zone. They're saying it's in a buy zone, anything in that range. That's huge, right? That's big by big. So if it's on the buy zone and you want to add your own little personal touch to it, why not let it prove that it's going to hold from the breakout and then find a way to participate in the move? The only risk from waiting is that this turns into a momentum play. It never pauses and it just runs to the moon without you. And then you would have missed your chance to participate. But you would also have missed your chance to get in and then get stopped out when it dumps back down. Because IBD also talks about the fact that if the S&P or the Nasdaq or both are not in a good trend, the overall market perspective is to approach with caution on any new trades, because the failure rate on any new trades, any new breakouts like this is very likely to fail. The failure rate goes up when the S&P and the Nasdaq are not in a confirmed trend, and we are not in a confirmed trend, right? So they would say there's the signal, approach with caution. Normally they'll have a little spot right here that says we think it's doing one of these three things: market in an uptrend, market under pressure, or trend under pressure, and then not in an uptrend. We must be in that part of the morning where they change the setting, right? So Crown Holdings was one, GSL was the other. With a lot of the companies that were down yesterday, red to green plays are going to be a big deal today, right? If you've gone through any of my next level library material about some day trades, we find an intraday trade first by looking at a red to green opportunity. So, for an example, with GSL, if GSL was rallying up in the pre market after having a red day yesterday, we would want to see this rallying up at least as high as the open of yesterday, to open at least that high. It's a red to green flip. This is a poor example right here, but it was a red day. It rallied up in the pre-market higher than the previous day's high, and then it rallied out of the range. When you're putting together your morning watch list, the list can get really big really fast, right? And you're trying to narrow down the names that are on your list because you can't really try to watch and trade 20, 25 names. It's just too many names, right? You need to be able to cull the list down to a manageable 2 or 3 names. Inside day breakout, IX10 patterns, red to green setups, trendline breakovers, bear pennant failures, all of those daily chart patterns become intraday trade opportunities with 4% movers, right? And that's been the target goal on those is a 4% day, meaning we actually go in and target the options 4% out of the money. You can trade $7 options that turn into $250 opportunities by the time you close it. Yeah, I like risking $7 to make 250. It suits me. All right, everybody, that is the morning briefing. Be careful, be safe. I will see you all tomorrow.